Welcome investors to Fiscal Voyage. I'm Felix, and in this video, this is part 3 in this Dividend Aristocrat series that I'm putting together, where every day I'm uploading a new video of the next Dividend Aristocrat. So if this is your first time visiting the channel, make sure to subscribe so you can see tomorrow's video of the next Dividend Aristocrat. And also in the description, you can see links for the last two videos, part 1 and part 2. So make sure to check those out. And the company that we're going to be talking about today is a company that's been growing dividends for 35 consecutive years. Also, the price of this company is higher today than when it started in January 1st. So that's a good indicator how safe and resilient this company is during this pandemic economic shutdown. And also earlier this year, the company increased the dividend by 12.5% in January. So it's a good dividend growth company. The company that we're doing today is ABT Laboratories. So make sure to watch towards the end of the video, because I'm going to provide you with a fair price based on current price to see if it's a buy, hold, or sell. So we're going to do a stock analysis on ABT Labs to determine if it's a good price. So let's get started. ABT Laboratories, ticker symbol ABT. The company is a multi-international medical device and healthcare company. It sells medical devices, diagnostic, brand generic medicines, and nutrition products. It also split off the research-based pharmaceutical AbbVie in 2013. I actually own AbbVie. It's one of my largest positions, but ABT Laboratories I do not own. But this is one company I definitely would like to have in my portfolio. But we'll see if it's worth it now. Fundamentals from 2010 to 2019, revenue had a negative rate of return of negative 1.1%. However, remember, they split off AbbVie in 2013. So that contributes to this, as well as the net income in that same time period. But if we look at the past 5 year, revenue had an average of 11.8% growth and operating income at 12.1% growth as well. So that's much better growth over the past 5 years versus the 10-year period. S&P credit rating is A-, which is investment grade, which is great. Earnings for the past 10 years grew at 5.5%. Again, this is, remember, with the split with AbbVie. But over the past 5 years, earnings had an average of 10.8% growth, which is great. And it matches the dividend increases. So we'll see that over here. Last year, earnings came in at $3.24 a share. Net margin was higher at 11.4% versus the 7.7% in 2018. The one thing I don't like is the current dividend yield at 1.67%, which is very low. But they're making up for it with the dividend growth. For example, the past 5 years, they've been growing dividends at 7.8%. The most recent increase was in January of this year, was 12.5%. So that's a much better double-digit growth rate. This helps offset the low current dividend yield. The dividend payout ratio is only 50%, which is right there under my criteria of 60%. The 50% is based on 2020 expected earnings. The company has 35 consecutive years of dividend growth. However, if you look at some sites, you'll see it dividend growth of 8 to 7 years. However, that's because AbbVie split off in 2013. So the ABT Labs did decrease the dividends, but if you own shares prior to that split, your income actually increased. So that's why they still consider 35 years consecutive dividend growth. Return on equity is only 12%, which is modest here. The charter rule gives us a 9.4, which is much lower than our suggested criteria of 11 or 12. So we have a 9.4 charter rule. And the 5-year dividend yield average is only 1.95%. So our current yield is much less than the 5-year average. So that's a good indicator, more or less, that the company is slightly overvalued. If we look at the balance sheet here, debt to cap at only 34%, which is pretty good here. Current ratio is 1.44. You like to see the current ratio, which is the current assets divided by the current liabilities. For most companies, you guys see it 1.5 to 2 or even higher. That's a good current ratio, but 1.4 is fairly okay. Debt to equity at 0.5, which is great here. The lower, the better. But preferably 1 or less, or 1.5 and less is average. But over here, Abbott has a 0.56, which is great balance. The price to book ratio, however, is much higher than the 5-year average, which was 3.59. Currently, it goes for 5.24. That's a good indicator that the current price is higher and maybe even overvalued based on the price to book ratio. If we look at future outlook, analysts are expecting 2020 to be $2.87, which is a decrease of 12% from last year, 2019, where they earned $3.24. Of course, that's because of the coronavirus pandemic and the shutdown of the economy. So, but even then, a 12% decrease is not too bad versus a lot of the other companies that have 50%, 60% expected earnings decrease. However, the bright side here, 2021, analysts are expecting a big rebound of about 30% increase from this year's expected earnings. CFRA is also projecting an 11% earnings increase for the next 3 years. During my dividend yield return model, I'm getting projected annual return of 9.8%. So it's right there, a little higher than my criteria of 9% or higher. So that's good there. However, the forward PE is at 30.8, but that's based on 2020 expected earnings of the $2.87. But the 5-year PE average is 22.1. If we look at the fast graph, as you can see here, the black line is the monthly closing price, the orange is a PE of 15, and the normal PE of the blue line is 20, where the company likes to tend to follow. As you can see here, the price is much higher than both the blue and the orange, so that's a good indicator here based on the fast graph that it's overvalued. However, if we were to revert back to the 20 PE based on 2021 expected earnings of $3.71, we have a potential of losing money actually. The total return of 11% negative, so that's something to consider here. However, as you can see, earnings has been increasing in the previous year, except for 2015 where it decreased 6%. But from 16, 17, 18, and 19, it was growing at a nice rate, 14%, 15%, 13%. And as you can see, also the white line is the dividend payout ratio, so it's very well covered by the adjusted earnings. Another thing to note here also is the blended adjusted earnings yield of only 3.45%. I like to see that in the 6, 7% or higher earnings yield. This is a good indicator as well that the company is overvalued just based on the fast graph. If we look at the fair price, however, from different analysts, CFRA has a fair price of $72, Morningstar of $75, fast graph as we just saw, $77, and Yahoo at $102, and my dividend discount model analysis at $82.08. For the dividend discount model analysis, I use a 10% dividend growth for the next 3 years and 8% after that with a discount rate of 10%. The dividend increase of 10% for the next 3 years because in January they increased it almost 10%, and next year they're expected, a good recovery, and analysts are expecting double-digit earnings growth for the next 3 to 5 years. So this is why I use a 10% for the next 3 years. So we average out the 5 fair value prices from the different analysts. We have a fair value price of $81.77. Currently, the company goes for $88.52. That means it's overvalued by 7.6%. Thus, I have a hold recommendation for this company. So I'm recommending a hold for Abbott Labs because of the price overvaluation. It's not tremendously. It's the fact that the PE is high, even based on 2021 expected earnings. However, I do like that earnings are going to be growing for the foreseeable future, but I just don't like paying price to earning ratios of 22, 25. I would, however, consider this company if it was a PE of 18, 17. I would open a position. This is definitely a company that I would like to own in part of my portfolio. I own the other part of this company that is split in 2013, ABT Inc. That one is one of my biggest positions, and I would like to own Abbott Laboratory eventually, but not at current prices. I like the dividend history, 35 plus years. I like the dividend growth of double-digit growth. I just don't like the low dividend yield. And the dividend yield is higher than the 5-year average, so that, something turns me off there. So I like the direction of the company growth, just not, I don't like the valuation. So that's why I have a hold recommendation. But I think you guys should put this on your watch list and have it maybe a price alert or something, so you get alerted maybe when it has a PE of 17 or 18. But remember, when I give these recommendations, a buy is a perfect example for you to further research it. It might be attractive for you. A hold is, like I mentioned, to put in your watch list and something to consider in the future, maybe when the price drops. And a sell is don't waste your time on it. Maybe focus time on other positions. So thank you for watching, and look for part 4 tomorrow, sometime tomorrow. And make sure to subscribe so you get notified of part 4 and part 5 and part 6. So thanks again for watching, and like the video, and see you tomorrow.